Hey guys, welcome back to the channel. Today we're going to get into a quarterly review of how my M1 Finance portfolio is doing compared to the S&P 500. If you haven't liked and subscribed, make sure to go ahead and hit both of those and hit the post notification bells if you want to get notified when I post. At the beginning of the year, I set out to show the people that you could beat the S&P 500. You can beat the S&P 500 by investing in stocks from the S&P 500, essentially beating it with itself. And you don't need an expert to tell you what to do. This goes to show that investing in the stock market over time will grow your money. As I've said before on this channel, the S&P 500 grows about 9% per year, meaning that it's safer to put your money in the stock market than it is to put it in a bank. Short term, it's safer to put it in a bank, obviously, so you don't lose money, because the stock market does go up and down, but over time, it will go up. So how am I doing so far? Well, with a portfolio of $930, this is comprised of an 11.6% return on my investment, $59 coming from capital gains, and about $2 coming from dividends. Once I invest my $70 for this week, I'll have $1,000 in this portfolio in just the first quarter of 2021 alone. But what stocks have done the best? Which weeks have done the best? Well, my best week was January 15th to 21st. That's up about 14% for the year. This includes Twitter, who's up 30%, Southwest Airlines up 25%, Stanley Black & Decker up 16%, Oracle up 13%, Cigna Corporation up 9%, LKQ Corporation up 8%, and Alexion Pharmaceuticals down 1%. My smallest week is my most recent week, which is probably just because it hasn't had time to grow, but it's up 0.41%. This includes Fortune Brands Home and Security up 5%, Akame Technologies up 3%, FedEx also up 3%, Cognizant Technologies up 1%, Cigna Corporation down 0.6%, Salesforce.com down 0.7%, and Fox Corporation Class B down 10%. Given the amount of time it's been around, I would say my most disappointing week so far is the week of January 8th to January 14th. This includes Cigna Corporation up 14%, Teledyne Technologies up 7%, MasterCard up 4%, Exelon Corporation up 3%, PPG Industries up 3%, Visa down 0.16%, and Perrigo down 7%, for a grand total of a 3% gain since this time. You're probably wondering what my best stock is. And up until a couple of days ago, I thought it was going to be my Discovery C-Class stock that I got. And it was up over 80% at one point. But now it's only up 2.76%. It's crashed in the past week significantly to get it to just 2.76%. But 2.76% in the first quarter is still a good number. If it can just grow 2.76% for the whole year, every quarter, then it'll be a good percentage at the end of the year. However, as of right now, my best stock that I have is Twitter, when I bought it in January 15th through 21st, and it's up 30%. I have to specify which week that I bought this because ironically, Twitter is also my worst stock that I bought March 5th through 11th, down 21%. But this is the importance of dollar cost averaging. If I had been putting in my money in month over month into Twitter using these two data points, I would still be up 9% for the quarter. 9% for the quarter is way more than 9% for the year. And this is where dollar cost averaging comes in. Having 9% isn't as good as 30%, but it's way better than negative 21%. This is a perfect example of how the market goes up and down over time. But over time, it does tend to go up. So you need to dollar cost average or invest consistently over time because time in the market is better than time in the market. My advice for this has been and always will continue to be invest consistently into an S&P 500 index fund. Over time, your money will grow. Yes, you'll miss the Teslas and the Amazons that grow 200% in 1 year. But you'll have consistent growth that you can count on year over year. Speaking of the S&P 500, how do we compare? Well, the S&P 500 currently sits at 3,974.54 points, and it started the year at 3,764.61 points. This is about a 4.05% growth for the year. I, on the other hand, in my M1 Finance portfolio, have grown 11.6%. If you take this 4.05% growth for the quarter and expand it over a year, it turns out to be about 17% growth. If you take my 11.6% growth for the first quarter, it turns out to be about 55% growth for the year, which would be astounding for investing in an S&P 500 index fund. Obviously, we still have a long way to go, and the stock market could go up or down or remain flat. But if I hadn't invested my money, I wouldn't have grown it to this 11.6% return that I'm currently seeing. So my advice is to keep investing in the S&P 500 index fund. And you can do this by starting your M1 Finance or Robinhood accounts with the links down below in the description. Without further ado, let's see what the random numbers are and pick the 7 random stocks that I'll be investing in for the last bit of this quarter in my M1 Finance portfolio. At 462, we have UPS, also known as UPS. At 47, we have AMAT, or Applied Materials. At 96, we have CNC, or Centennial Corporation. At 391, we have QCOM, or Qualcomm. At 148, we have Dish, or Dish Network. At 273, we have KMB, or Kimberly-Clark. And at 7, we have ADBE, or Adobe. Here you see me investing my $70 plus 76 cents that I haven't invested from the dividends that I've previously gotten. So you'll see how this grows over time. With this money, you'll see that my portfolio now goes to $1,000 for the quarter. I'd like to see how it grows throughout the rest of the year, and I hope you'll stick around to find out. Make sure to start your investing accounts with the M1 Finance and Robinhood links down below in the description. Make sure to like and subscribe, and until next time, see ya!